All right. What's going on, everybody? Hope you guys are all having an absolutely amazing evening. Welcome to our Sunday night session of our live trading room. All right. We are going to get rocking and rolling here in just a little bit. So Sunday evening, lots of stuff to cover, lots of things to review, lots of things to go over. As we saw a little bit of movement last week, and so I want to give some credence to the fact that we had a little bit of movement last week. And so what are we going to do with that on this week? So let me slide over and share my platform. I guess I should put it on the right screen, and then that wouldn't be a problem. All right, so let's go ahead and get rolling today. We had a lot going on last week. This is our final session of our live trading room, so for our free preview week. So for those of you that are joining us that are in our live our free preview session, great. Thanks for coming on board and seeing kind of what it is we do and how we do it. I'm glad that that you took the time to come on board with us. For the regulars, share your thoughts, share your insights, please. Everybody know that we want you to put your opinions out there because I like to talk about it. So all right, let's go ahead and get going. S&P's down about 10 points this evening after a fairly bullish move up last week. We talked about some bullish strength potentially coming into the market, and that's kind of what we saw last week. So overall, as I'm looking, yikes, the oil spike. We'll talk about that because we did notice that gas is shooting up a little bit. So in our major market comparisons, over our last 20 days, let's do our last 20 days, we've gone positive again in the S&P. We're positive 6% in the NASDAQ. We are down 6% in the Russell, and we are slightly negative in the Dow. So the Russell still underperforming the market in general. And even when I go to the last week, we just look at the last 5 days in time, we will still see that that the Russell actually no, I actually anticipated a little bit less. The Russell actually did have the strongest week last week, and so have we shaken off the stink, if you will, of the regional banking crisis? Has the regional banking crisis come and gone and poof, no more worry about it, right? So we would anticipate if we see the Russell leading the NASDAQ, leading the S&P, and leading the Dow, for that trend to continue. That's normally a picture of a continuation when the Russell is in front of the NASDAQ, which is in front of the S&P, which is in front of the Dow. So what am I looking at for this week as far as that continuation and what may happen? Well, the S&P is down 12 this evening, and we're down 12 this evening on our big old spike in oil, right? We gapped up huge in oil. I mean, gapped up huge. Now, what's interesting is that just before the weekend, I was looking at potentially selling calls in USO. Glad I didn't do that because that would have been a hot mess. And so we gapped up over the weekend. This, by the way, is why I talk about we don't hold futures over the weekend unless you have them hedged utilizing options on futures. That's why we don't hold them over the weekend without a proper hedge in place. So S&P is reacting a bit negatively to that on a little bit of a pullback. But I'm going to get rid of a lot of these lines because I got a lot of lines on here that make it very difficult to see. And I want to start essentially from a fresh perspective. Now, we ended the week on a strong move up, but we ended the week in a supply area. Excuse me. Going back to our supply areas, this is a rally-based, very strong drop. We ended the week in a fairly decent little area of supply. Matter of fact, if I move that to a 4-hour, that's the very top of this strong move down. I would not be surprised to see us pull back into this range here. right? Somewhere into 4,100. I would not be shocked at all to see us pull back into that 4,100 level, right? And so that 4,100 level is, I think, a pretty good area where we could see a potential turnaround and heading back up. So let's move this to the 1 hour chart. And when I go to the 1 hour chart, we can see that that was the breakout of this level in here. It occurred right around a market open. And what I have in here that I like is I do like this. It's slightly unbalanced, but we do see a wick over wick area right in here. So 40.98 by 40.88 would be our wick over wick level, where we would anticipate price moving back into here and getting some sort of a reversal. So some sort of a reversal out of this level, price to hit here, reverse, and then head back up. And so I think that's a strong opportunity to get long. You do have a decent little level right here. So this level in here that's much closer to current price, I don't feel like it's quite as clean, right? Now, when I go to a 15-minute, this isn't quite as clean either, is it? Strong move up, little wick back into here. So when I take this to the 15-minute, I'm actually going to tighten it up. Now, why do I tighten it up? I tighten it up to reduce my exposure, right? Reduce my exposure, reduce my overhead risk that is staring me in the face. And so when I'm looking at this one, I would look at 40.94 by 40.88. I'm going to switch that to purple, remembering that purple indicates a 15-minute chart, a level found on a 15-minute chart. Now, why does that matter? That matters for our 6-candle rule, right? I'm always dirty. That sounds awkward, Rich. I'm just going to throw that out there. That matters for our 6-candle rule, right? And so if price comes into here, if it doesn't start moving in 6 candles, walk away, right? Walk away. Now, as far as this area up here, when I move to the 15-minute, it's not quite as clean, but if you want to give this little, I call that a noisy cricket level, because that's a wick over wick on a 15-minute chart. That little wick over wick. We've got wick A and wick B right there, those two wicks. That would be a bit of a noisy cricket level to me. I don't love that. And the reason I don't love that is a couple of things. Number one, the time of day that it was created was late Friday afternoon. Not the ideal level time. Now, I do like the fact that it's the origin of a pretty decent move up. And so if you're a bit more aggressive and you want to make a trade this evening, I think you may get a bounce off of this level. I would play this for a 1.5 to 1, maybe, reward to risk. Look at that as a 1.5 to 1 reward to risk trade. I mean, you're looking for quick money on here, probably prices coming up to this 41.30 level. So not a big move to come out of there, and your stop at the tightest would be below the red candlestick's lowest wick. So that would be right here, right? So if you think about this, that means that if that's my stop, that is my risk. A 1-to-1 risk puts me here, right? And then a 1.5 to 1 risk puts me right about here, which is my opposing area of supply. Imagine how that works. So it's not an ideal level by any stretch of the imagination. But for those of you that want to be a bit more aggressive, then I'm okay with that, right? You know what, Liz? I will tell you, I didn't really even look at volume yet. Let's look at volume and talk about that, because that is something that will play a part. I like to look at volume. When I look at volume, I like to look at volume on the ETFs. Well, we didn't have strong volume, you're right, throughout the end of the week. Matter of fact, it was anemic volume. We did have above average volume on Friday, closing on the high. Let me check our other ETFs. NASDAQ was rising volume. that did get above an average volume. Dow volume was garbage. So, interestingly enough, Dow volume was garbage, never got the spike. S&P volume got a big spike, and NASDAQ rallied up throughout the week. So, Russell also got the spot. So, yeah, there was a lot going on Friday. I do like the fact that we closed on the high with such a surge in volume, right? And when I say such a surge in volume, mind you, it's 112 million on the shares versus the prior day was 73 million, right? So that's almost, what is that, a 50% increase in volume? Not quite, but almost, right? And so, yeah, the weekly candle closed on the high. I don't love the fact that our weekly candles did have lower volume, so I would agree with that, Liz. This volume signature right, where I see this price shape and this volume signature means that we escalated volume on the way down and we decreased volume on the way up. So while I agree with you that I do like the way price action shaped up, I don't love the lack of follow through in volume from there. And so I'm wondering, are we going to get back above this area here on that weekly chart? Now, remember, our weekly chart, we had a pretty decent little run up until we put in this area here, but we've not gotten a lower low yet, right? We have not yet gotten a lower low. We have a higher high. We do technically have a higher high, and technically I have higher 3 consecutive higher swing lows, right? Yeah, there could be for sure a lack of sellers in that region, Liz. But if I'm just looking at swing highs and swing lows, right, I would consider swing high, swing low, swing high, swing low, swing high, swing low. Come on, you rat. And then this is not officially a swing high as of yet, but I certainly have 3 consecutive higher lows and technically 2 consecutive higher highs. So I would call that a very weak uptrend on that weekly chart. And so on the intraday chart, of the ES, I'm going to continue to say bullish is probably the best way to go on a quality pullback if you are most aggressive. If you're most aggressive, you can take this first entry at 41.19 with a stop there at 41.13, target up here around 41.30. And if you're more conservative, then look for an entry down here at 40.94 by 40.88. By the way, can I get both? I think you could. I think you could easily get both. If we pull back into here, you get a rally back up to here. Price then comes back down, 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 and sometime tomorrow we hit this area and skadoosh, we shoot up. I think tomorrow, the day after, somewhere along those lines. Okay? So now, by the way, what about overhead supply? Looking at my overhead supply, I go all the way out to the 4-hour chart, and in going all the way out to the 4-hour chart, I got to look above current price over to the left. And when I look above current price and over to the left, I look up, I come here, let me get rid of some of these areas there. My next closest area of supply on the 4-hour would be this area up here. Now, that's the origin of a pretty strong drop in price. Is it the origin, or is it a bit of a retest of some of these levels over here to the left? 6 of 1, half dozen of 12, as my kid would say. Could be a little bit of either one, but I like the idea that we have a chance for price to rally up into here, and there's room to run all the way up to there on a reversal. Okay, I'm not saying I'm going short up at that level for any sense, because if we're that strong up, but I think that this is a slightly unsustainable, nearly parabolic move up that is oftentimes met with a strong whiplash move back down. I wouldn't be surprised to see us rally up to here and then whiplash back down and retrace half of this move. Okay. Rich, there's lots of activity on the indices throughout the day. That makes it difficult to attack them for a positive outcome. Well, I think that really depends on time frame, Rich. I'm a huge believer, and I cannot state this enough. And some of the members in here make fun of me, but I don't go below a 15-minute chart ever. I just don't. I've found that you're right. There's a lot of activity on the indices throughout the day when you get down on like 5-minute, 1-minute, and 2-minute charts. But there's just no way that I'm going below a 15-minute chart. I just don't do it. I think there's lots of room when you stay on bigger time frames. Bigger time frames are really, in my mind, the secret to that. And so 15 minutes is as small as I go. I actually prefer to stay at hourly levels and above, which is why, I hate to say this, a lot of people are looking for like sexy trading rooms where people are in there and they're just taking trades and they're going pow, pow, pow. Look at how good I am. Look how much money we made today. Woo! No, that's not my style. And frankly, most of the good traders that I know, it's not their style. The style is to identify areas where we may see turning points on big pictures, set the trade up, walk away, allow it to do its job, right? And so you like my pew, pew, pew. But that's what I'm looking for. I'm looking for those kind of bigger picture areas of opportunity to find those turning point levels. All right. Moving over to the NASDAQ. So sliding over and taking a look at the NQ. Yeah, bigger candles, bigger, higher moves are in the higher time frames. That's for sure. So as I look at the NQ, lots of levels below and above me. The NQ gapped down today and is starting to trade down, but it's not gapped in the direction of the predominant trend, and it did not gap out of the prior day's range. So this is not what I would consider a gap and go scenario. It's just not. Matter of fact, I think that this little wick over wick here is a really enticing place to consider getting long. And the reason for that is A, it's a nice wick over wick level right through here. B, we touched it on this wick on this 7 a.m. candle. C, we had this area here with these areas of resistance. Now they're terrible, 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 and the rock means terrible times a day, but they are still a little bit of an area of resistance that could attract enough buyers. Old resistance oftentimes acts as new support. What would make this level that much more palatable is if we get into this level on the S&P at the same time we get to here in the NASDAQ. That, to me, would make for a nice entry for something that could reverse and head back a bit lower, right? That's kind of where I would look for the entry for a long position. Now, I've got a little level below there also on a 15-minute, which kind of mirrors the S&P level, but the NASDAQ being overall stronger than the S&P, I would look for the NASDAQ to enter this level at around the same time that the ES is entering this level. So if the NASDAQ reaches that 13,151 at the same time that the ES reaches the 4094, although the ES, if you look at these two side by side, if I were to look at the exact same levels at the exact same time, I would say, well, this level here mirrors this level here in the NASDAQ. But the relative strength of the NASDAQ would then require me to take the level that's just a smidge higher, or as they say in baseball, just a bit outside of that area. And when we're just a bit higher than that area, that's where I think that turning point would then exist. Could I take a short until we get to that area? I mean, if you want to, if you're ready to and you want to go counter trend, there is certainly a 15-minute short that might be attractive right here. Understand that it is counter trend, which means anytime we go counter trend, by definition, it's a confirmation entry, right? Because our big picture 4-hour trend is still up. And so with our big picture 4-hour trend being up, the only way I can take that is on a confirmation entry, but that is still also a potential setup as well.
Chuck, quick comment.
Oh, hello, Liz.
Hello. If you put your fibs on the last swing high on a 240 chart, would it shock you if I told you that 13,151 was right around the 23.6 area?
From here to here?
Uh-huh.
That would not shock me at all.
Well, it is. It's sitting right there within just a handful of ticks.
Hold on, let me come back to... Let's pull that up and take a look-see. Yeah, so from here to here, add in our 23.6 retracement, and look at that, sticky. That would be an area of confluence, right, where Fibonacci levels meet up with traditional support and resistance, supply and demand, fair value price areas, whatever terminology that you want to use. I don't care if you call them razzle dazzle levels, as long as it gets you, as long as the trade works. Don't care what the level is. Although maybe I'll patent razzle dazzle levels and create a new indicator and become the guy. All right, I'm not the guy. I like to think I'm the guy, not the guy. All right, so those are the NQ and S&P levels, respectively. I could, we can call it the razzle dazzle strategy. So this area of supply, we've hit it a couple of times. And so when I see a level that looks like that, when you see a supply zone up here, because that's really what this is, right? This is a supply zone that has been hit once right through there, and now we're bouncing below that level, just chopping sideways. That should right there scream breakout, right? To me, this is a breakout candidate above 1820. So the Russell above 1820 looks, in my mind, to be a potential breakout candidate. I don't know that I would lean on the reversal in the Russell at all. I think I'm definitely more likely to be interested in the breakout. Even when I move to the 15, that's 4 hour. Even when I move to the 15-minute chart, the levels, they just don't have the same appeal as the ones do in the NASDAQ and the S&P. I mean, that one's okay because of this upper wick that hit right through there. So I'll leave that one on at 1794 by 1791, but I'll be frank. Actually, I'll be Chuck. You guys can be frank if you want to. I'd much rather stick to the price action that exists in the NASDAQ or the S&P for a reversal, but I do like the potential for a breakout in the Russell, provided that we get the quality basic. All right, next would be our YM. YM, UCM, yes I do, MR Ducks. All right, I know, I'm a redneck. All right, moving along here. All right, so as I look at the YM, similar to the S&P, this level sticks out at you like a sore thumb, right? This level's like, hey, trade me. And then this level is better than both, right? Matter of fact, that's a really nice level because that's a retest of an ascending triangle pattern, right? We have a nice basing area here for a potential breakout, ascending triangle pattern through here, formed before a market open, pretty good time of the day, with a really nice rally. So similar to the ES in that the lower level is better than the upper level. The upper level is if you're a bit more aggressive. I don't like any of them on a 15-minute chart. So I like them on the hourly. I don't like them on a 15-minute at all. They're garbage on a 15-minute chart, but they're clean on an hourly. So the hourly certainly is going to be more important. You will always find a reason to not take a trade if you go slower, if you go smaller in time frames. By the way, you'll also find a reason to take a trade that's not the right one if you continue to go lower in time frames. So that's why time frames are so pivotal important, and we teach which time frames to use depending on your style of trade. And knowing your style of trade and the time frame that you select is clutch, as they say. All right, so those are our equity markets. Any questions overall on our equity markets? I'm going to take this grid and I'm going to share it to our Traders Army trade feed. Oh no, I forgot to, hold please. I forgot to start the new page. All right, so here's our trade feed for this evening. Share this grid. So I put this into the trade feed. For those of you that are watching on recording, or for those of you that are not regular members, this trade feed is a picture of the levels that we look at and identify. Now, why this is useful, and I'm just going to show this for everybody real quick. Even if you're not a Thinkorswim subscriber, if you just put that link into your platform, it'll show what are our supply and demand levels. So it takes basically a screenshot of what we looked at. I know a lot of people use a grid that shows supply levels above current price and demand levels below current price on multiple time frames. We actually just show the picture of the chart. So that's kind of the way that we show the grid so that you can see it very cleanly. All right. Next, let's go talk about that big move up in energies and metals. Specifically our crude oil jump, right? Our crude oil jump. Now, we got OPEC cutting production. OPEC came out and said, no. We are finding way too many reasons that oil is dropping. And so we've decided that we're going to have voluntary oil output cuts. So they're going to cut oil production. They're going to cut about it looks like 1.2 million barrels a day in production. And the market responded in kind with a sharp gap up. Now, what does that sharp gap up mean for traders and investors? Well, first of all, let's talk about this. Was there any reason to be holding a long position over a weekend? Let's just call it out. No reason. A couple things to consider. Number one, you don't hold futures over a weekend without a hedge because you never know what the heck's going to happen. Number two, we were sitting in a supply zone. So if you were in a long position, if you're in a position, so you might be excited, like, yay, my long position, look how much money I'm making. You got lucky if you're in a long position. Now, what about if you held a short over the weekend? Because you said, oh, we hit supply, and so I'm hoping that supply, I'm going to short oil at the beginning, at Friday afternoon, so that I can hope that it gaps down on Sunday night. Yeah, bad idea. So while I'd love to say, hey, look at all the money you could make by being long futures, and the market was going up. So if you would have just held it, you would have been walking down the yellow brick road. It's ridiculous. There's no reason for you to have been long heading into the weekend, especially with us being in a supply zone. So if you made money on this because you held it over a weekend, shame on you. And I don't mean that to sound like condescending. I mean it to say one of the worst things that can happen to you is that you make money on a mistake. Okay. It's funny. I was coaching my son today in baseball, and my 11-year-old. I mean, he's not Willie Mays Hayes. He is not a super. What's the word I want to use? Fast. Like, he's not super fast. He's not athletic. He's not a super athletic guy. He's a good pitcher, great pitcher. That's his jam. Well, he got a base hit a couple of weeks ago and was coming home to score, and he jumped over the tag. Completely everything against what we told him to do. He jumped over the tag, happened to be safe, right? Being safe was the worst thing that could have happened to him. So now he's trying to jump over every tag at home plate, and he's getting tagged out like it's going out of style in every practice because he was rewarded for doing the wrong thing once. Same thing happens in trading. If you get rewarded for doing the wrong thing, it's actually worse for you long term. And so what can I do with it now? Well, what's it going to do now? A couple of things that we are looking at of where it can go at this point. So first of all, the gap fill opportunity exists and it is real. So let's just remember that we could theoretically see a gap fill. Move this to a 1-hour chart. The gap fill would be coming all the way down to here. The other thing that we may want to look to see is what's our distance from gap to opening candle, right? From closing price to opening price. And let's pull a fib at 50%. Now, is 50% truly a fib number? Not really. It's not truly a fib number, but I have seen many, many times that these gigantic gaps will, at 50%, have a reason to reverse. Now, as I look further to the left, my 50% lines up also with these areas of resistance over here. Now, this area here lines up with the 61.8 retracement. Okay? So I would look for this area in here between the 50% and the 61.8. This is where I would be looking for a potential candle-to-candle entry. Okay? Now, Greg says, what about a gap and go? So let's talk about a gap and go. Can we trade the gap and go strategy? Well, what's our predominant trend? It's obviously up. Did we gap outside the direction of the predominant trend? You bet your assets we did, right? We gapped outside the direction of the predominant trend. Can I trade a gap and go? Yes, you can. If you want to trade this on a gap and go trade, your entry is going to be above 81.69. Your stop is going to be below 79.81. The only challenge I would say that exists in that strategy is your comfort level with the amount of risk that trade creates. Okay? You've got an entry above 81.7, call it 81.70 for an entry. I do those the wrong color. Okay, so 81.70 for an entry. What's our low on this candle? 79.80. So 79 for a stop. Right? And then mathematically our target would be at 85.52. All right, that would be a 2-to-1 reward to risk ratio would be this area up here. Is there anything that can stop us from getting to 85.52? Well, you've got a little bit of resistance. Actually, I got to get further out. I got a bit of resistance here at 82.70 that certainly could be a stalling point. That's actually a pretty strong level of resistance right to here, 82.70 by 82.90, somewhere in there. So I don't know that that's going to be the best trade because of that area of resistance above us. That being said, can you do it? Sure. I think you might want to use something like a call option on the USO as a surrogate for that, right? Or a call option on the CL, right? Maybe you just want to go with a slightly out of the money call option on CL and trade the options position on there. Right? Options position would allow you to still benefit from that bullish move up if it happened, while still being limited in your overall risk and exposure, right? So let's go out to the option that's got, now we'll do the 19-day. Open interest sucks on those. Mays are too short. Let's go to the Junes. Yeah, you got to go out to the Junes. And you can do the June like 8150s. Now notice the June 8150s are a delta of 49. So the market's basically saying, listen, we think it's a 50-50 shot that it'll be above 8150 on that June expiration. That's only going to cost you $3,800. You put a stop loss on the other side of it. That may be a good way to trade this. Right? Trade this using the options as a way to take risk. Well, yes, so same rule for the debit spread. You could certainly still do a debit spread, but understand this, Vince. Your 25 debit, your 25 net delta, it's actually going to be a 250 net delta, right? So like the 80 by 85 would give me 183. I need a 250 net delta. Somebody tell me, why do I need a 250 net delta? What's my reasoning? Right, because when I trade stocks, it's 100 multiplier, and when I trade these, it's 1,000 on the multiplier, right? So in that case, I would need a 250 net delta. You can certainly still do it. 78 by 85 would get you a 325 debit with a 256 net delta. Worst case scenario in here, I mean, you're risking $3,200, but you're not really risking $3,200 because your stop loss would be down here at 79.79. Of course, the stock would have to be at 81. The oils have to be at 81.70. So, if we took it from where it is today, that's was that $2 worth of risk? So let's give it $2 worth of risk from where it is today. So if current price is here, your real exposure on that on day one is about $550, right? You get a couple of days in, let's call it 7 days in, you're at about $600 worth of risk. So that actually may be a decent way to trade it. The problem is you don't get the same reward to risk ratio. So I'm not in love with it because of the resistance that exists up and to the left for the gap and go. Now, that being said, this area in here for a potential candle-to-candle entry, can't type today. Okay, right there. Now, remember, candle-to-candle entry means that I would need to have a reversal candlestick pattern in that area and I would get in once that candlestick's reversal pattern has been done. I actually prefer that over the gap and go. All right, next is gold. Gold touched a little over 2,000 an ounce and held that as a pretty strong area of resistance. So I think that there's still an opportunity for a breakout above 20.06. So above 20.06, you've got a chance for a breakout. I think that price could continue to run a bit higher. You've got that resistance at 2014. You've got some resistance way over here at 2060. So I think your best opportunity in gold would be that breakout above 2006. Might we get a reversal level a bit low? Ooh, oh my. Look at that. I love that level. Oh my God. Becky, look at that level. It is so big. Actually, it's not. It's a beautiful level. 1958 by 1956, we have a rally, base rally. The time of day is okay, not the greatest, but I really love the structure of a rally, base rally above a pivot low. Yeah, I did throw a little Sir Mix-a-Lot into a trading day. Now, some of you may say, yeah, Chuck, but that's on the old contract, and we're not trading the old contract. Well, if enough people are looking at the same chart that shows the old contract, then that level will work out just fine, right? That's what I care about is that does that contract still hold water? I'll look to this area here to see, do we get that reversal? Now, if you stick to just the M contract, that level doesn't show up at all, right? So I'm okay as long as we think there's enough people that are going to be trading off of that same chart to utilize that 1959 level as a reversal point. All right, next is natural gas. Natural gas gapped down today and into this little itty bitty area of demand. So gap down, traded down into this little bitty level of demand, and then from there got a nice rally up. And if we can continue to go up from here, I think that this would be a nice little move up on a gap fill trade. Overall, this is just garbage and almost impossible to trade right now. So I'm out. Right? I'm not interested in this thing. Okay? Not interested in this one at all. All right. Let's see. Copper. Copper. See. As I look at this on a 4-hour chart, what is that 4-hour chart telling us to do? What's that 4-hour chart telling us to do? As I quote from the 80s song, look away, baby, look away. Don't look at me. I don't want you to see me this way. Okay? So I would walk out. Let it go. Let's see real quick. Sorry, I'm doing multitasking with a couple of other people that had a question. All right, good. So any thoughts on energies and metals? I think crude oil gives us a best opportunity using the candle-to-candle entry somewhere inside of that range. And so let me see if I can find the best way to zoom in on that. There we go. There we go. Gold, I like the breakout above that region there. But other than that, I'm not all that interested in any of the levels down below. And then nothing in nat gas or copper. All right, let me share this grid. I will put it in the chat. And I will put it on the trade feed. Oops. Control V. All right. Next, let's take a quick cruise by agriculturals and see if there's anything in the ags that we like and are big fans of. You know, my 4-hour chart is awful strong in soybean as well as in corn. Strong 4-hour level, big move up, parabolic move up even, to the point where I would consider that a speed candle. And anybody who's heard me speak has heard me say this a million times. What typically tends to happen with speed candles? If you know the answer, type it in the chat box. What typically tends to happen with speed candles? Yeah, they typically seem to get retraced. A speed candle always may not happen today, it may not happen tomorrow, but it takes a little bit of time, and so regularly those tend to get retraced. Okay? And so if that gets retraced, then I think that we're going to have a really good opportunity between 1479 and 1472 in order to get long. Okay? I think that would be a really nice strong entry because our 4-hour trend is up. That would be a retest back into this region here. That's a little bit higher than this area of support that we had back there in the past, which I think would then serve for price to continue to move higher. So that's the speed candle retracement. What about overhead supply? Well, as I look at this 4-hour overhead supply, none of this is great. There is nothing exciting from an overhead supply standpoint that's going to lead me to believe that this is a great entry. Now, might we retrace? Kelly put in the 50% level. Might we get it? Might we retrace in here? Well, if I move to the 15-minute chart, that level is tempting to consider. The only reason why it's not higher on my list is that it's already been tested. This wick right here means that we've already tested this level. And how do I know that? Well, at one point, this was a big green candle. We then dropped down and closed here. The next candle opened here, dropped down to here, and then shot straight up, which means that this wick is a reaction to this level. And that wick being a reaction to that level makes that level less fresh and makes it less probable for price to move. So on the 1-hour chart, which is why it's better to stick to the bigger time frames, this area here is the origin of this pretty strong move up. I do also like this area here for a bit of a line. Call this a line of support. Old support broken through, acts as resistance broken through. And so if we break through that area of demand, we may find some more support here at 1446, but I'm not in love with it. What about the two lower wicks above it? John, are you talking about on the 15? Two lower wicks above it. Oh, I see. Are you talking about these wicks right here, John? Those two right there? Okay. Yeah, I mean, those certainly, there's definitely some demand there. Are those right at 1,500? No, 1498.50 and 1498.75. So the very, very tips are not quite at 1,500, a little bit below them. I think there could be some demand there, but I feel like they're a bit in no man's land. I would agree with that, Liz. But also they could all, the one over here might be the origin of a move. and then this is its retest. Because really, what makes that level work is this wick right here. Well, what does that wick have to do with the price of tea in China? Well, are we still allowed to say that one? I don't know if we're still allowed to say that one. The price of toes. I don't know if we say that either. Anyway, just kidding. So price rallied way up to here, then dropped down to here, and then rallied back up. So in reality, when I'm looking at this area here with this high upper wick, right? What I'm really looking at is price doing more like this, right? So here's that green candle. And then here's the next candle. And then here's the next candle. Right? So I just drew these three candles. Right? I put a little gap in between them. So in that case, this area here becomes its own area of demand, which is the bottom part of this wick, which means that this is a retest of that little area of demand. And because we traded all the way to the exact bottom of it, we probably used it all up. Does that make sense, John? It looks to me like it's a used area. Well, the retest would make for a support level, but remember, what happens to a support level the more often it gets touched? It gets weaker, right? It gets weaker. And so I don't want to rely on it, right? So I would let that one pass. I actually, John, would be more likely on the 15-minute, now that I've been on this 15-minute, it's been staring me in the face this long, would be more likely to be interested in this here. Because that's a wick over wick on a much smaller time frame, which is, I bet you dollars to donuts. But if I pull a fib from here to here, that's going to be a significant level. Looky, looky, shocker. And I bet you if I pull a fib from the low to the high, that we've got our 23.6 right in that region. Uh, 23.6 is just a little bit below from the low to the high. So yeah, I mean, I could see that working out actually pretty well. Okay. Next is corn. Nah. Corn actually has better supply than soy right up here on a 4-hour chart that we're approaching. And this parabolic move up, I wouldn't take this on a limit order because this is also really good supply that we blew right through. I wouldn't take that on a limit order, but I do like it for a potential reversal coming back into here as a confirmation. How did I get two Fibonacci level 14s? All right, there we go. So that's between 673 and 676. Greg, I do have a good ear for corn. I mean, it's one of those ones that when corn pops, you pay attention. Wheat doesn't have the same appeal to me as corn or bean oil. I'm sorry, or soybeans. And then bean oil, definitely an uptrend, definitely gapped up outside the direction of the predominant trend. with room to roam. So if you're looking for one that you're interested in a potential gap and go, I actually think bean oil is a better one. I think so far soybean oil is a better gap and go candidate than I think it was crude oil we looked at earlier. I think soybean oil is a better candidate for a gap and go above the first candle's high. Stop goes below the first candle's low. All right, let me share this one out. Paste this in. All right, let's take a look at bonds and currencies real quick. Let's see. Let's take a look. Wow. I mean, this just screams, let's trade it. Not interested. Wow, is that garbage? I like the 1 hour up above us here. I think that level stays. Could we get a breakdown? Yeah, we could, but then I got this little area of demand down here. So I'm not gonna add anything else to our 10-year note. I think we've got enough trades set up here in the 10-year note that there's nothing for me to add. 30-year note, same picture, essentially. Nothing to change or nothing to add on that one. Matter of fact, to the point that I don't like that level that I just took off either. All right, the euro. So the euro has been strong, but over the last couple of trading sessions, we've seen it fit to pull back, and it looks a little bit like a bit of a Batman pattern that could be forming, right? With these two high wicks on the top of the cowl, and so that might be a decent little entry, especially if we break down below the low here at 107,641. If I go to a smaller time frame, oh yeah, as I quote the Kool-Aid Man, oh yeah, or Macho Man, Randy Savage, you know, brother. 108,854 by 108,949. I do like that level. I don't like when it was formed, but I do like that level. Step into a Slim Jim. All right. Yeah, I like it. And then the Canadian dollar. Well, look at the Canadian dollar. I'm so proud of Canada. They're so awesome. All right, good job, Canada. Way to be in a bullish move on your currency. We are heading into playoff season for hockey. I'm just kidding. Don't be offended. If you are offended, stop it. Somebody said one time, I'm offended. I said, well, then stop being offended. Well, what do you mean? I mean, there's no reason to be offended. Stop it. but you can't tell me how to feel. Yes, I can. They didn't like that. I know I'm not sensitive. So I do like a couple of these areas here in the Canadian dollar. 736 and 733, I think, are both pretty good levels for reversals. And that would allow the uptrend to still remain intact, but also give it a good, healthy rest. If we drop back a little further in this Canadian dollar level than that, then you're going to change your uptrend overall. So to keep the uptrend intact, we would look for a reversal right into there. Okay? All right, let me share this grid out. All right, I'm going to type this in the chat box. And I will put this also in the trade feed worksheet. All right, so real quick, we are right about at the end of our hour. I'm going to type in for those of you that are interested in becoming full-fledged members, I typed in a promo code. It's Trader60. If you're interested in joining Traders Army, we give you 60% off your first month. I hope you enjoyed the free preview week. Hope you learned something, got a chance to experience what we do. All of our on-demand content is always, no tuition, but our live trade rooms, we really want to build a great community. So for those of you that are members, if you want to tell people what you think about it, great. We love having. I genuinely, most of the members have my personal cell phone number. Shoot me a text, call me. I want that. We want to do our best to make everybody as excited about being part of a damn good community as possible. So I hope you guys think about coming on board as full-fledged Traders Army members. I know Corey Lane has put out an email about a class that we are releasing soon. It's called a stock repair class. And I'm excited about this stock repair class. Corey and I have been doing a lot of work on our fund about how do we lower the break-even cost of stock without adding any additional risk or exposure. And so, in doing that, it's going to be a course I think that's going to be really, really good for anybody that's an investor. So, if you're a premium member, you're going to get that course just as part of what we do. And so, for everybody else, it'd be great to see if you're interested in jumping in. So. Liz, it is typically a pretty strong month. The old joke that it comes at, in stocks, it's in like a lion, out like a lamb, whereas spring is in like a lamb and out like a lion. And so the idea is that in the equities markets, April is typically fairly strong. You're coming out of Q1. It's a way to get Q2 off on the right foot. And so far, that's kind of what we're showing and kind of what we're seeing. And so in like a lamb, or in like a lion, out like a lamb, meaning that we start second quarter big and bullish, and then we move a bit bearish towards the end of second quarter. That would be kind of the phraseology and what we would look at. And so as we're looking at, I didn't want to hit the on-demand button. As we're looking at our major sectors in here over the last month, we do still see that technology is up 6.3%. It's by far the leader, whereas over the last month, the S&P in general is up 0.93%. Energy is down 4.54%, but I don't think that's going to last long, especially with the OPEC production cut. A lot of other things are performing very close to the market, but technology is the one that's leading us out, and I think technology where most of our opportunities abound. A couple of those. Yeah, Greg, the weekly charts are showing a bit more on that bullish action. I didn't pull up today our SPX, but let's pull it up on our 8 and 20. Remember, it's the close above the 8 that tells us, hey, I can get back in. And if we bring our 8 and 20 back in, we did close up above the 8. Now, that doesn't mean that it's going to stay there, but now our out would be a close below the 20. So closing up above the 8 would say it's okay to be bullish. Now, when the markets are a bit sideways, that becomes a lot more difficult. But what you don't want to do is miss out on one, and then this happens. Skadoosh, right? And so the whole point is to get in, so hopefully you can catch the next ride like this, which is going to force you to have a few ins and outs. But by closing back up above the 8, that would give us a slightly bullish action. All right. Hope you guys have a great night. Thank you all for joining us this evening. If you have any questions, always let us know. I'll talk to you soon. See ya.